Hi guys, welcome back to the channel. This is G Money with G Money University. As you can see as the title on the video, today we're gonna be talking about what is Forex, right? I'm gonna break it down in simple terms for you guys to understand. We'll get through this as quick as possible, that way we can get back to chart analysis and actually making some paper. To break down what Forex is Forex is one big market that you can exchange one currency pair for another. Simple as that. Forex is currency. Forex stands for foreign exchange. Now, there's a bunch of different markets in the world. You got stock markets, real estate, cryptos, options, futures, commodities. Can you guess which one I trade? You guessed it right. Yeah, I trade Forex and commodities. Now, what is Forex? Let me break it down for you. Let's say you're traveling, right? Let's say you have $1,000 and you're traveling to, I don't know, Europe. They have the pound. You can't bring $1,000 US dollar out there to their economy. They have the pound. You have to exchange it. So once you fly there, you get off the airport, you go to one of those places that says Forex, right? You take your $1,000 and you go exchange it for the pound. Now, let's say once you exchange it, let's say you stay out in Europe for 5 months. Exaggerating. You don't spend $1, right? You have that $1,000, you got off the plane, went to the spot that says Forex, exchange your $1,000 of United States money into European money, which is the Great British Pound. Then from that point, you stay out there for, I don't know, 4 or 5 months without spending $1. Then you come back to the United States. Most people would think like you'll exchange the $1,000 you bought 5 months ago, or you exchanged 5 months ago, the British pound or in the pound would be $1,000 when you bring it back. You're wrong. Once you bring it back after like 5 months, you turn it back into US dollar, they're gonna give you back like $800, $900, $700. You're not gonna get that full $1,000. And that's simply based off of the exchange rate, which the exchange rate fluctuates on a daily basis, depending from what country's currency against other countries' currencies, right? Okay, you following? Okay, cool. Now, how do you make money in the Forex market, right? That's not how you make money by just exchanging it off the airplane from US dollar to pound. You don't make your money like that. So how you actually make your money in the Forex market is you're speculating on the exchange rate from one economy to the next. And if that seems a little too complicated, don't worry, take a breath, sit back, calm down. I'm gonna explain it for you.
I'm only gonna say this one more time, sir. Calm down.
I'm calm!
So what's traded in Forex, right? Money. Money, pimp. Come on, dog. Money's traded in Forex. So for example, let's say you see a pair that says Euro/USD. And let's say that the price is like 1.13000. That means that you have to buy €1 with $1.13 of the United States money. Right? Okay, you following? Cool. All right, next. Basically, Forex, you're comparing two economies and you're speculating the exchange rate to bet on what economy is going to be stronger or what economy is going to be weaker. So that's simply what Forex is. Forex is the exchange rate, the difference between one economy's currency and another economy's currency. Now, naysayers are gonna say it's gambling. It's too much of a risk. You don't wanna put your money in the stock market because you're gonna risk it all and lose it all. Shut up. Shut up. Okay, like let me calm it down a second. All right, I apologize. I didn't mean to get out my temper. The difference is, yes, you're kind of in Forex, you're speculating on what economy is gonna rise and what economy is gonna fall, and you're betting on which economy versus the other. Simple as that. But the difference is gambling. Let's say you're on an RTA bus, you're driving home from work, and you're shooting dice. Well, you know how to shoot dice. You hit 7-11, you take your money home, you win, right? Let's say you're on your last $2. You have your headphones, you put them on the ground, you're rolling dice. There's no signs right? In dice, you got to hit 7 or 11 to win on your first roll. After that, it's different, but we ain't gonna get into that way. That's a different video. There's no signs in rolling dice whether those dice are gonna land on a 7 or 11. It's a complete gamble. Versus Forex, you have what's called technical analysis, which is basically you see those crazy charts with the candlesticks and all the crazy lines that these people put on their charts. And you have trends and breaks of structure and liquidity sweeps. That's technical analysis. So it's what you see the markets moving. It's called price action. Then you have this other thing called fundamental analysis. Now, fundamental analysis has to do with the world, right? Like the president, government, economy, the Federal Reserve, monetary policies, raising interest rates, lowering interest rates, the unemployment rate. It has to do with actually what's going on in the economy. So you have to pay attention to what's going on in the world. Now, what you get to do is you get to take both technical analysis after you just broke down the chart. Now the charts, they look overwhelming, but they're very simple once you sit down and study them and actually look through the charts, you learn how to break them down. They're very simple, dude. You get to take technical analysis. So my theory of Euro, today, Junior. You get to take both fundamental technical analysis and what's going on in the world, and you put that together so you have a higher probability, and you take both technical analysis, which is the charts that has all the candlesticks. You get to look at it, break it down, and it looks overwhelming, but like once you sit down and study, it's really easy. You get to break down the chart. You can see what trend you're going in, whether it's up or down, see if any structure levels are broken, liquidity sweeps. That's technical analysis. Then you get to match that with fundamental analysis, which is basically what's going on in the world. The president, government, economy, Federal Reserve, monetary policies, raising interest rates, lowering interest rates, the unemployment rates. You get to take both technical, fundamental analysis, and you got to say, hey, with the information that I have, the United States dollar has to go up or it has to go down. So who trades Forex? Your mama. No, I'm just playing. Oh man, let me just slow it down. All right. So who trades Forex? To start off, like the main big players in the Forex game are gonna be the banks, right? Big banks like Citi Financial, Barclays Bank, JP Morgan. Those are the big players putting millions and billions and trillions of dollars into this market on the day-to-day. Damn, son. Big banks like JP Morgan, Citibank, and Barclays, right? Those are the big players putting millions and billions of dollars into the market. Then right below them, you have central banks and the government putting their money into the Forex market, like the Federal Reserve. And the last, you have the speculators, which is us, right? That's us. We speculate the markets and what all the big people are doing, and we try to get in and make our little paper on the side, right? Our little $50, $100, $10,000 that we're putting into the market is not moving the market for nothing at all. But we're called retail traders. So that's us. So you have banks like Citibank, JP Morgan, Barclays Bank. You have large commercial companies. You have central banks and government. And then you have us. So we're at the bottom of the barrel, right? Nobody really cares about us. Now, how big is the Forex market? This might be some of your guys' first time ever hearing about the Forex market, or not have done your own research in the Forex market. The Forex market's actually a lot bigger than the stock market. Isn't that crazy? The stock market with all these S&P 500s and all the companies in America, the foreign exchange market is way bigger. So like the stock market, daily trading volume, something like $24 billion. Right? Day to day though, that's a lot of money. Forex, that market volume is $7.5 trillion. So you're looking at trillion versus billions. It's a big difference. The Forex market is huge compared to the stock market. It's one of the biggest markets out there. Now, just to give you a little bit of history on where Forex came from. So let's take it back like years back to World War II when that was going on, right? What happened is it was a mess. World War II, you have Richard Nixon, President Nixon at the time. You have World War II going on, so the economy's going crazy. In the United States, their economy was about to crash. So what Nixon decided to do, there was something back then that was called the gold standard. What that was is basically for however many dollars or gold is out there, it's equivalent. And that's how the dollar had its value. What that stopped them from doing is that they can't make their own money. So if you're running out of money, just like gold, you run out of gold, there's no more to make. You can't remake gold. So when the dollar was like that, you couldn't just print money like they are now. So what Richard Nixon did is he took the dollar off the gold standard, which what happened is the reason why is it was going so bad in World War II. They needed money and funds to continue funding their army to fight this stupid war that they're going through, right? So what he did is he took the dollar off the gold standard, allowing the Federal Reserve to start now printing their money and print their own money at the time. What they had to do is create a system to stabilize the global economy, and that's called the Brentwood system. Now, before President Nixon said, be gone with this gold standard, but he beat it, kick rocks. Before that, only big players were actually able to trade the Forex market. We were not able to trade or even get close to touching the Forex market at that time. The only people back then that were like actually able to trade Forex were big speculators, like investment funds. Now, once he took it off, he said, be gone with the gold standard, took the dollar off, they started printing all their money. It allowed, now years later, with brokers that we have in the internet and Wi-Fi and all this extra lavish stuff that we had, we are now able to get in as retail traders, smaller speculators that don't really move the market. We're so minute to the big players in the market, but it allows us to actually get in, and when the big players are moving their money around, we can now use technical analysis and fundamental analysis to get our theory and initially invest with the big ballers. Now, the cool thing about Forex is like some people think like, you know, there's trillions of dollars that are being traded by these banks in these markets, right? And we don't necessarily need to put that much, even if we could, buddy. I don't got it. Oh, you heard? I ain't got that money like that, right? So basically, the good things about Forex is you don't have to have a lot of money to start with. You can open up an account anywhere from $10 to 10 million, right? Now, I wouldn't necessarily suggest starting an account with $10. I mean, realistically, you're not gonna turn an account from $10 to $10 million, right? I think when I first started, I started back 2020, so roughly at this moment, 4 or 5 years ago, right? I started with my account. I think I paid my first initial course was like, I don't know, like $300, and then I started my account with $250 in my account. And it's very easy nowadays to actually start trading Forex. Once you understand it, it's very simple. You simply contact a broker, you open an account, deposit money, and then you can trade from anywhere in the world. You can trade from the comfort of your home. You can trade while you're taking your kids out. Now, how to make money. So basically, you have what's called a lot size. And remember, we spoke about the exchange rate and the difference between this currency and that currency in the middle part. So what you do is those are called points. So every time it moves, for example, if your Euro USD is 1.13000, and if it changed to 1.13100, that just moved up 1 point. Now, a lot size is how much are you risking per pip, right? So if you risk a 1 lot size and it moves up a pip, you're gonna get $100 or $1, $10, whatever the lot size is. And that's how you make your money. So you are betting what economy is gonna be stronger or weaker, right? It's good that you can sell because you can still sell a market, right? If you think the US is gonna go down, you can sell the US dollar or sell the Great British Pound or the Japanese yen, right? You can sell that and still make money. So it's the same thing. Buying or selling is good both ways. So how you make your money is based off of that. Let's say after my technical analysis, my fundamental analysis, after looking into the economy, I put all those together, and my theory is that the euro, the pound, is gonna go up. I'm gonna place a buy with my lot size, and depending on how many pips, that's what it's called, pips or points, depending on how many points is how much you get paid, right? So if it's 100 pips times your lot size, that's how much you get paid. 1,000 pips times your lot size, that's how much you get paid. Now, what's great about Forex is, especially with this 21st century, they have things that are implemented which protect us as retail traders. Like I explained in the past, this is a $7 trillion market. You're trading with some of the biggest players in the world. You're trading with JP Morgan Bank, Citibank, Barclays Bank, the US Treasury, like, you know, big players, some of the smartest people in the world you're going up against, right? So there's things in Forex that can protect us, which correlate with us in the 21st century. You have what's called a stop loss. Let's say I'm at work. Let's say I place a trade on the way to work.
Welcome to Good Burger, home of the Good Burger. Can I take your order?
And I'm not able to monitor the trade really. I'm not really be on the charts like I can't be sitting here and just, well, I got a job to do. Like, you know, I'm still working, you know, I got a job to do. So what it is it's a stop loss, meaning you can place a trade at a price and you can set a certain amount of pips. Remember, pips is how you calculate the price, how you calculate price or points. You can set a set amount of pips for your stop loss to where, let's say you get busy at work, you close the trade, or you close your phone, you can't be on the trade, and price goes against what you're saying. Let's say you're buying and price drops. You have a stop loss where it can protect your money, protect your investment. You can place it 10 pips down, 20 pips, 30 pips, 40 pips below your price, meaning that if price ever gets close to this, this is the max amount that you'll be able to lose. They say it's gambling, but everything I've explained in this video, it's very strict and step by step. And there's a lot of things they put into place to enhance your edge and enhance your chances and actually being right in the market. So that's what a stop loss is. That protects your money if you're gonna lose a trade. If you're wrong in your analysis, your technical analysis, a fundamental, something was wrong, and your trade, a stop loss will help you save your money. Now, there's also something that's called a take profit. Let's say that, again, same scenario, I'm at the gym and I have to get my set in and I don't want to be distracted, so I'm not really looking at my chart. I can place my take profit at a certain point for price. For example, if price gets up here, it will automatically take my profit for me and take my trade out, and I collect the money. I don't even have to be on the market and I can collect this money. Now, when do you trade? Now, trading, even though the markets are open 24/7, 25/8, they never close. Even on the weekends when they close for us retail traders, it's so the bigger players can trade. The markets never stop moving. When can you trade? In Forex, there's something that's called sessions. Throughout the whole term of the day, there's different sessions, and different pairs have higher volatility in different sessions, right? So you have the Tokyo session, you have the London session, and the New York session. So 3 different sessions, and they're all different time frames. So basically what you can do is it works for anyone's schedule. Even if you don't want to take it full time and you don't want to be a multi-millionaire trading Forex, you can still learn it and adjust it to your schedule. You can say, hey, okay, I'm free. I get off work at 4. I go to bed at like 8 o'clock. So I get home at 5. So from like 5 to 7:30, 8 o'clock is when I want to be trading the market. Then what you do is you find out what session is in that time frame. You find out what currency pairs are most volatile in that session. And then you choose which one of those you've narrowed it down, and you choose which one that works for you and your schedule, right? You could trade it any day. Me personally, I trade indices and commodities. So for me, indices like US 30 and NASDAQ, they start at 6:30 in the morning here in the United States. So I trade from 6:30 a.m. to 8:30 a.m. and that's it, 2 hours a day, maybe 3 if I'm really, but that's it. The rest of the day, I can go to the gym. I can have my full day at work. I can go shopping, I can go to the beach, I can still do all of this, and I got my trading done because I trade at my specific session. You don't want to be sitting on the markets all day long, staring at the markets, waiting to find a trade. Now you're trading through multiple different sessions, and certain currency pairs aren't volatile in sessions, so you're sitting there for 2-3 hours just watching the price consolidate. And we'll get into that. Consolidate just means that the market goes sideways, right? The market can only move 3 ways. It can only go up, down, or sideways. So you're going to be in an uptrend, downtrend, or consolidation. That's one of the best things about Forex. So what is Forex? Forex is a big market that allows you to exchange one currency for another currency. You get paid off of the exchange rate that you speculated depending on your theory and your analysis from using the technicals and the fundamental analysis that we just talked about through this whole video. So I hope that helps you guys. I hope I explained it right. If you have any questions, comments, or concerns, put them down in the comment section. DM me for any questions or concerns. Like, comment, subscribe on the video if this helped you out at all. And at least, man, sometimes I don't be making sense, brother, but I just be talking and speaking. But if this made any type of sense for you guys and it helped you out at all, please, it helps with the algorithm. I'm personally building this university to share the knowledge I have for you guys. It's the first video. I'll be posting videos every day on different technical analysis. I'll be doing live trades. I'm eventually get into daily lifestyle vlogs, right? So I have a lot of content being prepared to come out for you guys. Be patient, get a pen and paper handy, and start studying. Do something with your life, man. Damn. Besides sitting there acting like a bum. Learn a skill that's gonna make you some money, have multiple different streams of income. Now, don't go quit your job, but have multiple streams of income. Pimp, ain't nothing bad about that. So thank you again for tuning in. This is G Money with G Money University, and I'll see you on the next one.